My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. How many job losses does it take to stop a raging bull? A bull that produced the best month for the stock market in 33 years? Well, I think we might have found out today. It looks like 30 million. Yep, just as we learned that we had the best rally since January of 1987, an admittedly inauspicious year, but not until the fall. And COVID cases increased by just 1.2%. That's the slowest pace this month. We also got some incredibly bad news. More than 3.8 million jobless claims, bringing the total to more than 30 million over the past 6 weeks. No wonder the Dow tumbled 288 points. The S&P lost 0.92%, and the Nasdaq shed 0.28% today. This was an explosive situation. The market was overbought, and we got hit with yet another Great Depression-sized unemployment number. That is not exactly confidence-inspiring for me. I don't know about you. Okay, even when we saw a great labor market like we did before the pandemic, I'd still be concerned that after this run from the bottom, stocks have gotten too hot. We're now at plus 7.2% in the S&P short-range oscillator. That's the one I swear by. This is the one that called the bottom when it fell to minus 20s in March. Anything above plus 5 is overbought. A 7.2 reading makes me concerned, which is why we've been selling for my charitable trust, which you can follow along by joining the ActionAlertsPlus.com club. Meanwhile, there are lots of people who are itching for an excuse to take profits. Today's jobless claims number gave them one, and there'll be a lot more bad news behind it. All right, the big question is, does this market still have enough fire left in the embers to keep going? Well, let's think about what happened. What fueled this move from the market's lows? First, we got ridiculously oversold for days on end, and that's what this is, okay? Days on end. This was some of the ugliest down to up volume, meaning number of shares sold to bought in terms of on the decline that I have ever seen in my 40-year career. And this, what I just call, is just unsustainable. That is just way too much negativity. After the spectacular run, that prop is gone. You can't seriously argue that this market's too pessimistic anymore. We've been rallying like crazy. Now, it doesn't mean we have to revisit the lows. I don't think we'll see this again. I don't. As a matter of fact, I think it's highly unlikely that that'll happen. I mean, you can only go so far, though, on an oversold bounce. Not here, but not there. Second, when things got out of hand, the Federal Reserve decided to take a Malcolm X by any means necessary approach to propping up the economy. Fed Chief Jay Powell wanted to prevent the wave of bankruptcies that was about to wash over America, and he did it. He told us that, if necessary, the Fed would even buy distressed debt, junk bonds, so that troubled companies would be able to stay alive. Once he made that commitment, those companies have had a much easier time raising money. We've had only a trickle of bankruptcies instead of a torrent. I think that is the right call. COVID-19 is nobody's fault, right? There's no moral hazard here. There's no danger of inflation either. This thing is devastating. Anything that minimizes the economic damage, I say, is worth doing. But we've known about the Fed's moves for a while now. You don't keep buying stocks on the same old information, do you? At a certain point, it's what we call baked in, okay? Baked in. This is baked in. This is baked in. Let's keep going. Third, we thought our healthcare system would be overwhelmed by COVID-19, but thanks to the lockdown, that hasn't happened. We flattened the curve. We avoided the worst-case scenario. But again, that was a reason to buy 2 weeks ago, not a reason to buy now. Fourth, until yesterday, we didn't have any drugs that could fight this vicious mad dog of a virus. Yesterday, we learned that Gilead's got an antiviral called remdesivir that gets you out of the hospital faster. That's really its stock in trade. It's not a cure, but it could be the first component of a cocktail that makes COVID a lot more manageable. Dr. Anthony Fauci compared it to the AZT breakthrough in the fight against AIDS more than 30 years ago. Fauci's been non-committal about every other potential treatment, but he sounded downright enthusiastic about remdesivir. And that's why the market exploded higher yesterday. Could we have more upside from this drug? Absolutely not. It is already baked in. We need more anti-pandemic fuel, especially when you consider that we're about to reopen the economy, and that creates a whole new level of risk if we let our guard down. There are things we could do to lessen the risk, but in most of the country, it's still very difficult to even get tested, including New York City. That's right, the worst hotspot in the country, and you got to cool your heels before you can even find out if you're sick. We have no way of telling who's been exposed because we haven't set up any sort of contact tracing system. Masks, again, not enough. CDC says that they're worth wearing, especially if you can get those fancy N95s. Costco just made masks mandatory effective May 4th. Don't go there without one. Since the crisis started, I've regarded Costco, not the government, but Costco as the gold standard here because I followed that company for years, and they genuinely take the safety of their employees and their customers more seriously than anyone on earth. Put it all together, and I think the good news on the coronavirus front, well, already priced in, which leaves us with earnings. Now, so far we've discovered that the quarterly reports aren't that bad, but that's because January and February were so strong, BC, before COVID. They offset a miserable March. The final month of the quarter and the little we've seen of April have been downright hideous with a few exceptions, notable ones like Microsoft, which is uniquely situated to benefit from the stay-at-home economy, or Facebook, which saw some green shoots in April. As we go through earnings season, I think these hideous March numbers will start to take up more oxygen as a prelude to an even worse April. Apple and Amazon just reported solid quarters. Both stocks got hit in after hours trading, though. Amazon much harder because, well, they had to spend a lot of money to build out new capacity and cope with the pandemic. How could that have been a surprise? Apple had to pull its guidance, though, and their sales are bouncing back in April after a tough March, and I thought the quarter was beautiful. But when you hear pull guidance, what can I say? People get upset. These are some of the best companies in the world. Apple boosted its dividend and buyback. Talk about conviction. And even though their stocks are in trouble, I like both, okay? I would buy them. They're going to get hit, all right? I would buy them, particularly Apple, which I say own, don't trade. Don't forget, we got 5G coming down the pike, too. All that said, the rally from the lows, it made perfect sense, as did a big chunk of last month's crash. But now, the bottom line is we're going to need something new, something different. You know what? I don't know what it'd be. Without it, though, the market is simply stretched at these levels after a fantastic run. And if we rally without some new positives, and judging by the market's muted reaction to tremendous numbers from Microsoft yesterday and great sales from Amazon and great earnings from Apple, I'm not going to blame you, and I can't blame anyone since my charitable trust has been doing it. Ringing the register. Kyle in New York. Kyle!
Hey, Jim. How you doing, buddy?
All right, Kyle. How about you?
Pretty good, pretty good. Got home from work, having a beer, doing all right.
Oh, jeez. Oh, that's like the old days. Right? That's like the old days. Don't throw a party, though. Don't go having that much fun. All right?
No,
okay,
definitely
good,
not.
Good. I want to be sure you didn't have that much fun. All right, because I'm not. What's up?
So I bought Wayfair 5 weeks ago.
Whoa, then you're a smart guy.
$25.96. So I'm up about 400%. So I'm wondering if I should dump it or just ride it out.
All right, listen to me. Listen to me. You take out your cost basis tomorrow morning, okay? I don't care where you take it. Just take it. And then, you know what? Take that money, and I want you to go buy, when the store's open, a cashmere sweater. You can celebrate with the rest of us. You can let the rest run. I'm not kidding. But I need that basis taken out. I need to go to Aiden in New Hampshire. Aiden.
Jimmy Chill, what's going on?
I'm the chill man, although the wife is a little on the fence about the chill situation. Go ahead. What's up?
I got a question about Sabre Corp.
Really?
They signed a 10-year partnership with Google to have them handle parts of their IT system.
Okay, yeah.
It's trading at 22 and change since then, and it's shot down to around 7 where it's currently sitting. Sabre provides tech solutions to the travel and tourism industries. So what do you think about this as a potential play without getting directly into those highly volatile markets?
I just, I can't go there. I don't know what travel's going to be like. And, what you're doing there is saying, okay, listen, this one's so low it can bounce. And that makes sense. I mean, Carnival went to 8. Some of these things, Norwegian, they do bounce. But I'm going to take a pass. I need to go to Kenny in Kansas. Kenny!
Booyah, Jim. How you doing?
Well, Pop's name is Kenny. I always like Kennys. What's going on?
Hey, nothing much. Hey, so I'm a long-term investor, and I currently hold stock in AMC. This week,
Wow.
AMC announced that they will no longer be showing Universal movies since
I know.
Universal decided to continue releasing the movies on demand. So do you think that theater stock is a good long-term investment, or should this entertainment sector
I work for
be avoided?
Comcast, so I thought the high-speed numbers were great. People didn't seem to like the trade, but I don't know. Own the stock. AMC, no. I think Adam Aaron is a genius. He grew up about like 5 minutes from me. But I'm not going for the hard money. I don't want to go for the hard money. I want to go for the easier money. AMC is the harder money. Sabre is the harder money. And by the way, Wayfair's hard money too, or else I wouldn't tell them to take a little off the table. All right, the market is just too stretched. It is. Let's just call it as we see it. It's okay. I've been pretty bullish. It's too stretched. We raised some cash. It's all right. No sin on Mad Money tonight. Most dentists are close to help limit the spread of coronavirus. You try to get to see a dentist, they won't let you. It's closed. Well, what does that mean for a company like Align Technology? And what does it mean in the future? Talking to the CEO. Then I'm revealing a new defensive play that you should put on your radar, especially when I went over this checklist. It's more attractive. And more employees are working from home. How is an old favorite and friend, Juniper Networks, faring? I'm talking with the CEO after earnings. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.